Good morning, everybody. Welcome to the Flow Show, Tuesday, 15th of April. And a bit of a quieter morning this morning, but still some moves going on around the markets. So we'll get stuck into that. Good morning, Kay. How you doing, sir?
Morning, Ryan. Morning, everybody. Yeah, doing all right. Bit of a slow brain start this morning, but it does seem to reflect what's going on in markets as well. So I'm not overly worried.
No, exactly. And yeah, maybe we're in the eye of the storm before it all kicks off again. But let's see. Right, let's get into some of the headlines. This morning, China has apparently ordered a halt to all Boeing jet deliveries, being pointed out as part of this trade war stuff. But they have had an ongoing thing with Boeing over the last few months. I think there was some stories that they were going to be selling all their Boeing stock. They do produce their own aircrafts. But that's still not good news for Boeing. They dropped a swift 4.5% when that headline dropped. Over in Japan, a 20-year bond sale apparently had the weakest demand ratio since December 2023. Kay, any thoughts on that? Is it just it was a 20-year sale? Should we expect this sort of thing with yields going up and the state of global bond markets at the moment runs to safety, or is that a sign of potential problems?
Uh, oh, there's a question, Ryan. I think we've seen.
First one out the hat.
Yeah. I think we've seen so many different opinions for once, but also trades to hedge versus a lot of things. And I've been saying that on the shows last week as well. Expect a lot of those bond flows and auction results being very erratic at times because different accounts need to cover or hedge versus different outcomes. What I would really say is that globally speaking, we've had this first round of inflation, big inflation worries. But personally, I think that perhaps the bond market will find some footing just because the people may start to hedge against weaker growth. In which case, if you talk about weaker global growth, you could expect the bond market to recover a bit. People go back to auction. So that is where I'm standing at right now. But I do think that we still have to go through various phases, of not everybody can hedge or will hedge at the same time their needs or their portfolios. So we are still probably going to go through a very erratic scenario on that side.
Yeah. Okay. So maybe we shouldn't read too much into some of these numbers that we get from bond auctions and the like for a while then. Right, over to the RBNZ. Chief Economist Conway says further rate cuts are possible once the impacts from all this tariff stuff becomes clearer. It says tariff uncertainty is weakening the growth outlook, and inflation risks are tilted to the downside. Apparently, they're going to be launching a weekly GDP nowcast as well, and that'll be coming up shortly. So they're jumping on the bandwagon of playing pin the tail on the donkey as to what GDP is going to be on a week-to-week basis. Yes, mate.
Ryan, yeah, as Jimmy says, we are still on the
still on the pretty face. Oh, there you go. Well, I'm not talking about data yet anyway. I will be in a minute. So yeah, a weekly GDP nowcast coming from the RBNZ. RBA, they had their minutes out, and May has been circled on the calendar as a key date whilst they look through the global tariff uncertainty. They say that's been clouding their outlook. And it's not yet possible to determine the timing of the next rate move, but the May meeting is viewed as an opportune time to reconsider policy, although there is no predetermined decision. So May has been put in the frame for another cut by the RBA. Not that Aussie dollar is paying too much attention to that at the moment, everything else going on. Right, now I can look at the calendar. We've had some data out, UK data, jobs numbers coming out, and not too bad at all. No horror stories in that number. The claimant count for March coming in less than expected, at 18.7k, still above an upwardly revised 16.5 last month, but not as much as a 30.3k expected. The unemployment rate staying unchanged, so that was good news. At least a 3-month rolling employment change showed 206,000 versus 144 prior. Wages, they actually sort of went up. Last month was revised down. They were expected to move to 6% for the ex-bonus number, but came in at 5.9, so it's still a gain. Including bonuses, the number was unchanged again due to revisions there. These are still very sticky numbers. They're far closer to 6% than they are to 5% at the moment, or even sub 5%. The BOE will be wanting to see wage gains continuing, but not at these lofty levels. Somewhere probably around the 4% mark is probably ideal for them. So for the Bank of England, it's still sticky on the wage front, and that's been a bit of a thorn in their side for a long while now. Overall, as I say, the data not horrendous. I think that's the way the market's looking at it. It's not super great, but it could have been worse. And I think that's part of the reason why we're seeing a bit of a bid in the pound. We've just had the GDP data out last week as well, which all looked fine and dandy. So maybe, Kay, the pound's taken on that at least dirty shirt status again.
Yeah, I'm still a bit short euro sterling as well. And is one that I overlooked completely this morning. It seems that Vance has said that there was a good chance for a US-UK trade deal. He spoke on apparently on the BBC, or the BBC reported that. So that's an additional bit of wind in the sails for the sterling, I would say. Yes, and actually the opposite was true. Last week I did not really. Okay, we all understand this risk. The sterling being a risk currency now, but I didn't really understand why we should have moved that high on the euro sterling. So I decided to counter it. Yeah, it does seem that well, at least I think that we can see this a little bit for a little bit longer. This sterling doing pretty well again. But it a lot again will depend on how risk evolves, what the trade deals are or are not. Yeah, for the time being, I'm also positive for the sterling.
Yeah, absolutely. And that was a nice grab you got there in euro sterling. And yeah, I mean, I was obviously out the picture when all this was happening. But yeah, I think if a lot of this is obviously volatility. I mean, look, when you get in swings like that in euro pound, you know there's a lot of volatility going through. So yeah, I think if we settle down a bit now towards the fundamentals, we're probably likely to see this creeping lower a bit. But who knows how long that volatility.
I like your yellow line there. That is one that I'm looking at.
Yeah, that one there is a bit of an area. I have to go into the wider chart. It's one of the bigger fibs from this whole big move here. So it's also a level in itself, as you can see there. And I love it when that happens.
That's where we bounced from as well to do the last leg higher.
Yeah, exactly. So it's a big solid level down at that 85.20, which well, it starts from around 84.80. This was a level I was looking at if we were getting rallies up here. But obviously this is a completely different situation going through that. So volatility in play, but that's going to be a big support area down there into 85.20 through 84.80. Yeah, I might be tempted to hit a rally on this one if we get another one, depending on what the driver is on that one. But we shall see. Might have missed the boat. Just staying on the jobs data quickly, the ONS reported, though, this was a bit of the bad news, that vacancies fell in the quarter once again and are now below pre-pandemic levels. And that's the first time since spring 2021. So despite that jobs data not being horrendous, there's still some worries under the carpet to think about. Germany, the optimism that we got from the 500 billion Magic Money Tree Fund has been shot to pieces. Expectations, which is this economic sentiment number here, the expectation number, it had that big jump to 51.6, was expected to stay positive, but it went negative instead. So all the tariff Trump stuff completely overwhelming that positivity that we got from the 500 billion fund they were going to magic out of thin air. Current conditions, though, were just a little bit less shitty than they were previously. So that's some good news, but at minus 81.2, it's not exactly jelly and ice cream over there in Germany. We also had industrial production out the Eurozone, a bit of green there, month on month up 1.1% in February, year on year up 1.2%. Who knows, maybe some green shoots appearing in the hard data, but I wouldn't read too much into that. And as you can see there, the Eurozone zoo economic sentiment also turning negative. So all this trade sentiment stuff hitting those sorts of numbers, probably expect that to continue. OPEC, they cut their demand forecast for this year and next year, citing all the trade war stuff that happened yesterday. The IEA joined them today, cutting their forecasts as well for oil demand, global oil demand. They pretty much cut their forecasts by a third for 2025. So no one's in a good mood about anything at the moment. Now, we've had the EU bods over in America, Sefcovic, the trade commissioner, speaking to his US counterparts. Apparently, progress is being made on a more full agreement. So maybe something to come from that over the next few hours or days, that they get a deal done on tariffs and thus avoid the hammer blow. Kay, what would that do to the euro? Would that be positive for the euro, or would it be a reverse of all the risk stuff, why euros rallied in the first place?
We've seen on retracting the harshest tariffs a temporary revival in the dollar, but it's all been extremely temporary. So after perhaps a couple of waves, it should not be bad at all for the euro. Actually, Trump was already saying a couple of times over the past days or so that euro seemingly is doing their bit to bring down, well, let's call it whatever it is, VAT or whatever, but tariffs. So there is light there as well at the end of the tunnel. I do think though that psychologically in the market, the market is not ready to buy really dollars. So I think that the maybe one wave. Okay, I mean we undo a bit of that risk, which is normally negative for euro crossers, but then it's the Europe is directly concerned. So I think the second wave will be the euro go back up, and that is how we are trading and how we are probably going to trade going forward. All of those headlines, you're going to see several waves, and they can be totally opposite to each other. And I think we are going to continue in that. But right now, scrambling back on tariffs is somewhere meaning that the big gamble worked only half, because there is advance, but I'm sure, or I'm pretty convinced that Europe, for instance, is not going to drop VAT, because that is holding the some of the European countries, or most of the European countries just need that VAT to even financially survive. So that is not going to change, in my opinion. What they could do is like put a reciprocal quota and things like that, that would not be tariffed, let's put it that way. Yeah, but again, I think we are going to go in several ways, several directions, and it's all going to be in waves. But I think anything scrambling back on tariffs from the US side is going to provide only a limited support to the dollar in time right now.
Yeah, so let me throw this out there then. If Europe are reducing tariffs and agreeing to, they're going for this zero for zero tariff thing, apparently, doesn't that prove Trump's point that it is other countries that are putting tariffs on the US that he wants to level up? Because if they're all coming down, it makes them, it proves that they're the bad guys, that Europe's the bad guy rather than the US. Doesn't that change the picture a bit?
Yes, but the way it's been brought up is that it's the way it has been brought up by Trump and his administration is in fact they want to kill the trade deficit and the trade imbalances. Not, I mean, tariffs is only kind of one way of doing so. And will that work? That is, for me, not a done thing. Because the Americans will still be able to buy stuff, right? And it is still going to be a lot more expensive to produce in the United States. And with that in the back of my mind, at least, it's only going, whatever happens, going to be a half a victory. But it is kind of a victory in the sense that he gets everybody around the table. That's for sure.
Yeah, I think at the moment it's, I think Europe is one of the worst for tariffing other countries. But as we say, I think as Trump shown last week, it's his execution of all this that is proving to be his undoing at the moment. But yeah, I side with him in what he's trying to do and have done from the get-go, because I know that they're not the full guys. It is other countries like Europe who are making it difficult. But let's see, he's doing things in his own way.
Okay, you've got especially goods we are talking about now, right? And then there is thought about the pharmaceuticals. We are not yet at the point where services or digitals or banking services, because let's face it, I mean, yes, there are trade deficits, but we can talk about that for days, right? But
Yeah.
yes, there are trade deficits, but look at what the US gets on the other hand from it. They are dominant in the financial world. They are the reserve currencies. Everybody buys their debt. I mean, there are imbalances on the one hand, but the imbalances on the other hand have not been spoken about. I mean, let's face it, the US banking world, even if there has been a big concentration there as well, but it's completely dominant in the world, right? Payment systems, you just call it. They get so much on the other side that the goods in trading balances are just one part of the picture. And yes, we're focusing on that, but I think if you look at what's happening then and the reactions that we saw in bond markets and the reactions that we saw in risk markets as well, is that okay, the market is not out of what is going to happen, but the market is also not completely buying what Trump is trying to do, because they know that there may be other disadvantages coming, and then we are talking more about, as I said, financial digital services and stuff like that.
Yeah.
Yeah. So I think it's hard, but to look at the picture in just from one angle. But the thing is, now the market is basically focused on, yeah, okay, the tariffs first, and then we will see what will happen with financial and other services.
Yeah, well, we'll have to save it for a pub conversation. But I could tell you some stories about American banking outside of Wall Street and the big banks. It's the dark ages over there when you're talking on the regional level. You try asking for an FX rate if you walk into some regional bank. They have to phone head office, and it might take several days. So that's that's a story for the pub.
Yeah, absolutely. And look at the concentration, and look at the very few European banks which are still really doing well. I mean, you can count them probably on one hand, right?
Yeah, absolutely. Right. Well, staying with the US, New York Fed had out their latest one-year inflation expectation number for March. That sort of jump as well, following what we've seen in the Michigan and Conference Board and other sentiment data. That jumped to 3.58 from 3.13%. So higher expectations there. Fed's Waller, he's sounding a bit panicky. He says if the threat of recession arises, he would favour rate cuts sooner. The new tariff policy is one of the biggest shocks to the US in decades. And I hope he hasn't taken over Powell's mantle, because he says PCE inflation is roughly seen unchanged at 2.3% in March, and core inflation expected at 2.7% in March. Powell has given us the PCE data, the last two FOMC meetings. So he's sucked the roll right out of that. Waller is one of the bigwigs at the Fed, so maybe he's, as I say, taken over that baton and made that data redundant. So 2.3 PCE, 2.7 core is what we'll be looking for when that number drops, I think next week. Fed's Bostic, he's also thrown his cups and saucers in the air. It says the range of economic outcomes has widened sharply. Right now, the range of possible outcomes has multiplied. The boundaries of what I thought could be possible have been blown up. That's technical speak for I don't have a clue what's happening anymore. Please help me. I'm going to live under the sofa. Deutsche Bank, they've not got too cautious about things. They do see a 25 pip Fed cut this year. They see that coming in December. They weren't expecting any cuts for the rest of the year. They're now up to one cut this year, but only in December. That'll probably be changed to 4 cuts by the end of the year, probably by the end of this week, given the way those forecasts change. Treasury Secretary Bessent is going to begin his interviews in the autumn for replacement for Fed's Powell. His term is up in, I think it's May next year. So they're going to start interviewing, getting people in the autumn this year.
Shall we put in our CV? I would, you know what? I wouldn't mind 4 years at the Fed, to be honest.
4 years, yeah, a bit of trading. You do your trading book a lot of good if you're on the inside there. Definitely. Okay, right. I'm going to get AI to write my CV. So that's happening. Trump was out and about, obviously, says there's going to be some proposals on stopping the Ukraine war very soon. How long's a piece of string on that front? And he's also said he will do tariffs on imported pharmaceuticals soon. That's being put together. Russia's been throwing out the threats a little bit. Germany's Merz has hinted that he may send Taurus missiles to Ukraine, on which the Kremlin has replied that this will only lead to a further escalation. And then this morning we've had Russia's chief of foreign spy services speaking. I don't know if he was wearing a dark hood and long coat, but anyway, he says in case of NATO aggression against Russia or Belarus, damage will be inflicted on NATO as a whole, but Poland and Baltic states will suffer first of all. So a bit of a big threat there. Shows we've got a lot of work to do on getting a resolution over there. Goldie's CEO Solomon was speaking after their earnings, saying he's seen enormous volume in currency trading currently as people have been thinking about the dollar. It's probably a bit of a no shit Sherlock comment there, but just goes to show that that headline has been, or that trading action has been passing by his desk. That's about it on the headline front. Unless, Kay, you got anything else?
No. Just the confirmation that that the Japanese are going to start their negotiations on the 17th. Takazawa is going on the 16th to 18th, confirming that Kato is going to have a chat with Bessent about the yen. Actually, the confirmation has seen the yen pick up a little bit of strength, not much. Market is probably waiting to see now what's going to come out of those. But no, apart from that, I think we covered everything for the day.
Good. So a quick look at what's coming up today. We got some price data coming out from the US, import and export prices. We get the start of the manufacturing data for the new month via the Empire State, which has been a bit of a flip-flop wobbler of late, but it will still give us a little bit of insight into what's going on. And then we've got Canadian CPI coming up. We have the Bank of Canada meeting tomorrow. So this will probably just be used if there's a big variation, just to do some last minute scribblings on expectations for the BOC tomorrow. Overall, things looking like staying roughly unchanged. CPI at 2.6%. The BOC core number, no expectations, but that was last at 2.7%. And then all these other little bits and bobs coming in round about as expected. They will be watching to see if the tariff stuff is going to start leading to a bit of an inflation spike, which if it does, will probably push them further towards a pause. If market's expecting them to stay on hold tomorrow, but it's not a close thing, or it is a close thing among the economists. Some think they could still do a 25, but as I said, this will be the first central bank we get since all last week's moves and news. So what they think about it could be a bit of a blueprint for what we get from the rest, ECB being next on Thursday. Any thoughts about that data coming out, Kay? Anything you're looking for?
Well, thinking about it, we know that Mexico and Canada have been well before the blanket tariffs, have already been struggling and wrestling with Trump. So this could have a bit of an impact, I think, for on data, and therefore perhaps take the Bank of Canada one way or the other. Yeah, as we said, I mean, but it's like if like all of them right now, but especially perhaps in the Bank of Canada, it's about a 60-40, but I would say sit back and wait a little bit, but on the tip of my toes.
Yeah, absolutely. So, well, let's start there. Have a look at dollar CAD, which has been pinging around a lot. Obviously, we've had this big breakout of the old zone up here, and it's become resistance not long after. So that tells you that if we do get any rallies up to there, that's going to be a key level. It's carved through the rest. We're still ticking around this 138, 70, 50, 70 area, which has been a bit of a prior level. We had a series of highs up around here before we had the break all the way through. So again, no surprise to see the traffic coming in around there. So I think on this one, if you're looking from the BOC side of things, I think you've got to take it which side of the line we end up on after the BOC. But there's no real signs that we're bouncing very much at the moment off of these levels down here. But at least you can say it's stopped going down for now. And the longer that happens, then the more chance potentially we do see a bounce. But if we're back above that level and holding it, maybe we're going to start to make a bit of a dent into this drop that we've seen since then. So that's one thing to look at over the BOC. Lots of people looking at Euro Swiss as well. IONUT. What is the price action in Euro Swiss telling us? Apparently, that's your question. Well, it seems like anyone who's not trading the Swiss at the moment is being left behind, because it seems most of our room is long Euro Swiss at the moment. I'm giving it a go as well, purely because we've had this solid looking area down here in this big figure, the 92 level, which is looking, as I say, bit of a decent support area. Got to be careful though, because if we're all leaning the same side, that puts a big fat target on our back. So just coming into the short term, we have had a few tests. It is stepping up, and while it's doing that, it's looking okay. But we've got to break at least this for the last couple of weeks, this downtrend, and we're getting lower highs. And this is looking already very dead cattish this morning. So we've got to be careful. If we do start heading down to this 92 figure, then there's the potential for a break, considering we've tried it 3 times. Kay, you're trading more through dollar Swiss, aren't you?
I'm actually also in Euro Swiss right now, but I managed to get a pretty decent entry because I did go through the legs. So I bought the dip yesterday in the euro dollar, and then afterwards when it all reversed, I bought the dollar Swiss against it. So my average is pretty. My entry point is pretty good. But I psychologically I'm just watching at that 92 and a half as well. And then if we would drop below 91 and a quarter or so. But yesterday, and I've actually, while you were off, I've been talking already about the Swiss and the breaks that we saw of those broad ranges. Excuse me. But then yesterday, the day before as well, we had Swiss moving more than the yen, and that is not your everyday move. Um, yes, the Swiss has been bought a lot, but just in the back of my mind, I would not be overly surprised if SNB starts to smoothen this move a little bit. Now, they can hardly do something about the global move in the dollar. If the dollar continues to collapse, if euro dollar goes to 120, like people are saying, obviously that dollar Swiss is going to be lower, but they may at a certain point start to smoothen this move, because we are at all-time lows in the dollar Swiss. We are at all-time lows in the euro Swiss, and we know from Jordan days that they are relatively closely watching all this. I Yeah, I've chosen the euro Swiss as well because I'm not a big fan of the dollar still. But yeah, I mean, it's more like, are they going to come in to smoothen this? And yesterday was it yesterday? Yeah. Yesterday or just the day before, it was like a really interesting move, because we saw, without too much reason, euro Swiss move up like a big figure, and at the same time, euro dollar coming down, and that is kind of typical for when they intervene, the SNB,
Yeah.
because they will be buying euro Swiss, but then they have, due to their intervention scheme, then they will sell half of it, or about half of it, maybe 40% of it. They will sell euro dollar against it if they buy euro Swiss, for instance, and the opposite. So, and that was the kind of move that we saw. So that was kind of telling me, oh, they may start to be interested in stopping or smoothing the move here. But we have to be very careful, because if they do the opposite, like for instance, buy euro Swiss, buy dollar Swiss, do the other currency pair first, then they will actually buy euro dollar, because they have to sell half, or 40% or 45% of what they bought in dollar Swiss. They will then rebalance into euro Swiss as well. So I mean, there's different scenarios. For the time being, as I said, since I'm not a huge fan of the dollar yet, I'd rather try it at least via Euroswiss. But since it's a tryout, and since it's a tryout on something that we are not very clear or certain about, yes, there are the levels, yes, there is the risk or the potential for them to intervene, but I'm keeping it all small. I mean, I'm not going to bank my account on it for them to intervene, let alone put it back at 95 or 96 in euro Swiss. I mean, this is not the kind of market we are in right now.
Yeah, I'm the same. I'm not going big on anything. In fact, I'm taking the approach that I'm going to be splitting trades over several levels, rather than putting all my risk on one number and one sort of stop. So I've been buying little bits. I started at 67, added a bit at 45, got some bids in down to the figure. But yeah, I'm just going to split things up and keep it a bit wider, trying to account for the volatility, because it's not markets where you can just pick a number and go with a 20 pip stop and be happy with it. But yeah, and never rely on the SMB, of course. If they help you along, if you get a little spike and it's SMB related, don't look the gift horse in the mouth. But certainly don't trade this one relying on the bank to do anything. No free lunches from those guys. Mike, do I believe Aussie dollar is still a short below 84? I don't. It's not necessarily that I believe it's a short, but it's not. It's bearish. It's still bearish while we're below 64, because that's the obvious number. We've had all this, and it goes back 2021, and obviously particularly since the latter part of last year. We did try staging a bounce, but that 64 is the number to beat. But yeah, Do I think it's going all the way back down to 59? No, but it's still bearish. Okay, would I consider selling it? Perhaps, now that we potentially got the RBA maybe turning a bit more dovish, then maybe I might look at rallies. But again, I'd keep that small. I'd probably be more inclined for this one to think about a potential break, because we've been down below this for so long. If we do take it on and we do look to break it, it's probably going to be a bit of a runner. So that's more my thought about Aussie dollar at the moment. Yeah, shorts may still be valid. You don't want to be offside too far though, and a break long is something to consider. Well, I'll be considering on that one as well. I'm not going to. I'll have to look at Aussie dollar. This one's a killer. I got stopped out there at the beginning of April on my shorts, and that happened. Typically, that's trading for you. You know, I could have stuck it above 30s, but I decided to stick it above my big red line there. So I got tailed out the rest of my shorts at 110.25, and then it's been all the way down, even through the old magnet line. That was what I was looking to trade it to when I was hitting these levels up here, up into the 110s, 111s. So in the meantime, we're just, as usual, we're below this magnet line. Maybe we can have a look at the downside. So I'll be watching it from that side, perhaps to hit some of these range edges. But otherwise, this long sideways consolidation action is what I'll be looking to trade if we get a move to some of these extreme levels on the other side. But can't stay away from that 108 magnet for long, can it, Kay?
No, I think we are still in that broad picture, and I've also been talking about that. Not necessarily Aussie Kiwi. Well, actually, it was a bit Aussie Kiwi, because the Kiwi, especially from when the RBNZ cut was doing it and has been doing a lot better than the Aussie. So I'm still in the camp as well that for as long as Aussie doesn't break 64 figure 15, it's still, if you want to be long a commodity currency, it still looks to me like the Kiwi is the better one of both.
Yeah.
Now, specifically on Aussie Kiwi, I'm not interested at all here to trade it. But yeah, I mean, the Kiwi is also, we and that's what I've been saying many times. The market in Kiwi is a lot smaller, right? So it can go further than the Aussie. You compare it with. If you compare, for instance, other currencies, that you would be looking at the euro and the Swedish kroner in normal times. The Swedish kroner is the accelerated euro. I mean, the Kiwi can be an accelerated Aussie, and that is exactly what I think what we are seeing now. But also, perhaps the Kiwi is not as much under the China's push. So I think we can go a little further, but by the time we would be reaching those closer to parity, I think it's probably time to look at the other side of the Aussie Kiwi again. But yeah, for the time being, yeah, I'm still more positive on the Kiwi than I am on the Aussie.
Yeah, and Mike, you know, this is what I'm talking about when you're talking Aussie dollar 64. You know, this has been a big old strong support area. We broke down, we've tried it, and then you get the break. Okay, so this sort of 58, 40, 70 area is the Aussie dollar here at 64. Okay, where we've had these levels all in play along here, along that big fat red line. And you know, this is, you get a break here, you're going to potentially get a similar reaction like you've just seen in the Kiwi when it breaks up, similar to euro dollar when we finally busted through 105s, 106s. So that, you know, price action can be all the same. These patterns are all the same. Okay, so you just got to look to identify them. So yeah, Aussie dollar, you can try shorts up against these highs, but you want to be careful if we suddenly turn through and go through it, because onwards it may go. Right, Kay, I'm going to bounce it over to you for a few.
Yeah, just a couple today. I'm not. We have covered already a lot today, right? But cable, and in line with what's happening in the euro sterling right now, sterling is finding a bit, and we are closing in on this resistance zone. This is a prior high around 132.70, but 133 133 is an interesting level. Not only trend line, prior high, but it may be a bit of a psychological level as well. If that would go, then I think we're pretty rapidly going to trade this prior high again. Here a low, but okay, that was in between another move. But we may quite rapidly be there. And we've had some positives on the sterling. And as I was saying, what I didn't understand last week, or what I didn't completely agree with last week, was the rapid and persistent jump on the euro sterling, and we are coming back down. So that is also helping the cable. We can stop here. Obviously, we can stop here. 133. We can stop and then correct a bit depending on what the dollar does overall. But it looks to me like we may just be in for a bit of a walk. That is how I'm looking at the sterling right now, especially when you look at the shorter term that I've been showing last week. We first of all had the support around 127.1030, which held. Then we broke above 128.5, and it held. Then we went up in that 130 figure 40 zone, and we had a retest and it held, and we are going higher. So to me, that still shows that there is enough kind of appetite. Of course, never say never. If you start to go back below 131 and a half, 131.45, which is the first decent support, I would say. I mean, this is just a spike high. Well, I mean, if 132 holds already on a retest here, then we know it's really big. But I would rather look at mid 131s now or so. But we are in this scenario where I think it could go on for a little bit, especially if you have a hawk like Vance also coming up saying that there is a good potential for a UK-US deal. It could be enough to drive it through. And sterling in general, we are seeing on the cross side of things as well. Sterling in general is doing pretty okay, even for currencies where the other side of the pair is doing well as well. I mean, sterling yen, for instance, is also holding up certain levels. So yeah, I think all of that, it could be supportive enough for the sterling to go for a bit of a walk here if we start to break above 133. That's at least the way that I'm looking at it right now. I am going to have a quick look. Gold and silver. Actually, gold is just consolidating at very high levels. 32, 31, 65, 70 are your supports. But if it holds already 32, who are we to stand in front of it right now? Bit of consolidation. I would say we have to go below 31, 65, 70 to start correcting deeper. But for the time being, it's not happening. Interesting, the market is trading a bit more positive. People who are watching the gold silver ratio are seeing that we are back below 100. The funny thing is here that we are trading along that broken trend line and trying to get back above it. If that would happen, it's really where we are trading at now. Call it 32, 40, 50. If that goes, then I think we can have a visit back into the 33s, especially if the market continues to trade things on a bit more positive note. All right. So that is the way we're looking at it. Be careful for deeper retracements. If you would go back below 31 three quarters, then we could have a quick look back into the 30s. But for the time being, this is looking a bit more positive. The ones where I am less positive than what the market is right now, because the market thinks that a move back above 62, which we've actually seen, um, would testify that we may have put in a bottom. I would argue, though, that we need to go back above 63 and a half because before we can say that, perhaps even confirm 64, 65. But for me, for as long and look where we stopped that rally We really stopped in the 63s and then rejected it again. For as long as we are doing that, we're still in this same scenario of putting in lower highs, and actually the broken wedge is still pretty much alive. And there is a very simple line on Brent as well, and that comes in at around $66, and this is exactly where we banged our head against on any moves back higher. So I would argue the oils are still not out of the woods for as long as we are not breaking above that 63 and a half in WTI and 66 in Brent. This to me still looks like we may just try to find retracement levels and then go in for another move lower. Now, obviously, if the situation around tariffs, etc., finds a resolution, those things are probably going to fly again. But despite whatever EIA and OPEC may say, because they are just looking at the numbers, all right. But I mean, we know that if we get solutions, we get things solved. Then the market will look much more positive at global growth. And if you look positive at global growth, then you're probably going to see a rally in all things oil. Silver, for instance, is going to rally a lot higher a lot faster than what gold is going to do. And I am done for today, Ryan. Let's save some for tomorrow, shall we?
Thank you very much, mate. I will grab the screen back quickly, and I want to say welcome to Arif, who's decided he's going to take our offer on the discount that we've got running on the Forex Analytics platform. So I look forward to seeing you in the room, Arif. Don't forget to come and say hello when you're all signed up and plugged in. And if you need any help navigating around the room and dashboard, then just speak up and let us know. There'll be plenty of people to help you along the way. So thank you, Arif, for coming and joining us. Anyone else? This offer isn't going to last for long, so do take advantage of it. 40% off our monthly subscriptions. Quite a hefty discount that we're offering you. And one of the reasons is because we know that a lot of you traders, are going to struggle with all this volatility, understanding markets and whatnot. And we want to give you a good platform to come and get you through all that. In addition to what we do on the shows here and elsewhere. So grab that while you can. Come and say hello. And you need pros on your side, Arif. Well, you might find that you give us as much input as we hope to give you as well. So it's a team effort. Our users, our customers, our traders, they give me as much help and information as I hopefully give them. So it's a mutual thing, our chat room. So give that a crack. Let us know how you get on. And otherwise, thank you very much. Have a great day, everybody. Thanks, Kate, as always. And we'll catch you tomorrow.